Recently, major banks have begun launching their own stablecoins. The list includes Société Générale in France, Western Union in the US, and a 9-bank consortium across Europe. Even Japan's 3 largest banks. 2026 is shaping up to be another year of bank-issued digital cash. Stablecoins promise what traditional payments rails still can't. Transfers of value that are instant, low cost, and 24/7. The key question is, why now? Why do these institutions care about real-time, always-on settlement? What's the real advantage of programmability? What changed on the regulatory front to make this possible? And when banks launch these tokens, are they creating a tech or using someone else's rails? The core problem in payments hasn't been fixed for decades. Global settlement is still time-boxed and capital-intensive. Money still pauses overnight and on weekends, locking up liquidity across the system. Stablecoins, especially those issued by banks or enterprises, change that. They allow final settlement in seconds on ledgers that run 24/7, public or permissioned. For financial institutions, this is a major shift. Trillions of dollars now sit idle in portfolio accounts. Always-on settlement helps banks use capital quickly. Even a small increase in available liquidity, scaled globally, is significant. Cross-border payments are still among the most expensive financial services. Stablecoin rails cut many correspondent layers and reduce transaction costs. For players like Western Union, this protects margins while enabling cheaper transfers. In a world where consumers and businesses move digital assets 24/7, waiting until Monday for funds to clear feels outdated. Stablecoins align payments with what the market already expects: real-time money. This is especially true for trade finance and e-commerce, where speed now shapes retention. Recent data on USDC and USDT highlight this trend. They already move billions every day, non-stop. Traditional finance can't ignore that proof of concept, especially as those volumes start to increase. Speed and cost explain banks' motivation for launching stablecoins, but programmability shapes how they can use it. For decades, money has been moved only when prompted by people or systems. Programmable money changes that. Now, the payment includes rules, conditions, and compliance right from the start. Think about corporate treasury. Today, teams and middleware handle repetitive tasks. Programmable money automates this all. When a balance hits threshold, the transfer triggers. At Espeo Software, we've helped clients implement programmable workflows like this using smart contracts, automating settlements, thresholds, and payouts directly on chain. Our blockchain engineers work across layer 1 and layer 2 networks to design smart contracts that reflect real business policies. If you would like to explore working with us, go to espeo.eu/contact and fill out the form. The same idea applies to settlement risk. In markets, delivery and payment rarely happen together. This risk materializes when one party delivers but doesn't receive payment or the asset right away, or at all, due to a time gap. For payment companies like Western Union, programmability opens a different kind of opportunity. They can build new merchant products on programmable rails. The settlement process evolves into an integrated product feature within this framework. That's the jump from moving money to creating value. Then there's the compliance angle, maybe the most important for regulated issuers. For them, programmability isn't just about efficiency, it's about control. When you issue your own stablecoin, you can build your compliance rules into the token itself. You can whitelist wallets, enforce KYC, set transaction limits, or freeze tokens. It's not decentralized money. It's a policy-compliant digital cash running on open rails. Programmability in mind, the next key topic is regulation and its role in this change. None of this would happen without regulators defining how stablecoins fit into the financial system. For years, banks liked tokenized money but had no legal way to issue it. They risked stepping into the gray area of crypto. That's changing quickly. In the past 2 years, regulators in Europe, Asia, and parts of the US have built essential support for stablecoin issuance. So the technology hasn't been ready for years, but this is the first time the policy environment has aligned with it. For banks and processors, that changes everything. It removes the career risk from innovation. They can now handle tokenized money just like any other balance sheet. The next question is about the technology these institutions use for their stablecoins. Also, who really controls this new financial system? Here's what surprises most people outside the industry. Banks aren't building new blockchains. They are issuing their stablecoins on existing public networks, mainly Ethereum and Solana. They are layering their compliance, custody, and governance on top of each other. It's the opposite of how banks usually think about infrastructure. Instead of owning the rails, they are using the rails that already exist, but tightly controlling the asset that moves across them. Allunity, the joint venture between DWS, Galaxy and Flow Traders, also built its Euro stablecoin on the Ethereum network. Even Western Union's upcoming token, issued through Anchorage Digital Bank, will live on Solana. None of these firms wants to run their own ledgers. They want to own the coins. And that matters, because owning the coin means owning the economics. The issuer keeps the interest on reserves, controls the mining and redemption flow, and sets the rules for who can use it. This seems to be the new playbook. It lets institutions enjoy the benefits of open networks while retaining their risk, policies, and brand. That's the quiet revolution happening in 2025. Traditional finance isn't joining crypto. It's absorbing its architecture, bringing the story full circle. The question isn't whether banks will embrace stablecoins. They have already started. The real question is what happens next when the fastest, cheapest, most programmable form of money on the internet also becomes mainstream. That's all for today. Thanks for watching, and always, remember to stay on the block to stay ahead.